Hi, I am Dr. P. Dharmarajan, Assistant Professor and Head PG and Research Department of Commerce CA, Kamadena Arts and Science College, Satyamangalam. Today we are going to see Management Accounting. In Management Accounting, we will see the working capital. So first one is the meaning of working capital. Working capital refers to that part of the firm's capital which is required for financing short-term or current assets such as cash, marketable securities, debtors and inventories. In the words of Subin, working capital is the amount of funds necessary to cover the cost of operating enterprises. So next one is capital required for a business can be classified under two categories. So through fixed capital and working capital. So first one, every business needs funds for two purposes: for its establishment and to carry out its day-to-day operations. Long-term funds are required to create production facilities through purchase of fixed assets such as plant and machinery, land and building, furniture, etc. So funds are also needed for short purposes for the purchase of raw material, payment, wages and other day-to-day expenses, etc. These funds are known as working capital. So next one is concepts of working capital. There are two concepts of working capital. First one is gross working capital. The next one is net working capital. So gross working capital means it refers to the total amount of funds invested in the current assets. So examples of current assets: cash in hand, cash equivalents, accounts receivable, inventory, marketable securities, other current assets, etc. These are called as gross working capital. So just simply we said total amount of funds invested in current assets, it's called gross working capital. So next one is net working capital. So net working capital is nothing but the excess of current assets over current liabilities, it's called net working capital. These are all these concepts of working capital. So next one is factors influencing working capital. So first one is nature of the business. In nature of business there are two types. First one is industry type, then second one is business model. So in industry type, businesses in industries like retail or manufacturing typically need more working capital due to the inventory of purchases and longer production cycles. So in second business model, companies with a business to business model may have higher working capital than the business to consumer. So second one is production cycle. The length of the production cycle impacts the working capital. If a business has long production cycle, such as it may need more working capital. Then third one is inventory level. Companies with larger inventories or those hold stock longer periods will need more working capital. The larger and slower moving the inventory, the higher working capital required. Then next one is fourth one is credit policy. So credit policy, there are two types: receivables and payable. That is called bills receivable and bills payable. So receivable, a company offering longer credit terms to its customers will tie up more working capital in accounts receivable, increasing working capital requirements. So in bills payable, on the other hand, if the company can delay payment to the suppliers, it can reduce its needs for working capital. Then next one, fifth one is sales volume and seasonality. Sales volume and seasonality. High sales volume or seasonal fluctuation in demand can require more working capital to manage the peaks and the drop. Retail business, for example, often need more working capital during the holiday seasons to build up inventory. Sixth one is business growth. So business growth, expanding businesses may face higher working capital needs as they grow, requiring more inventory, a large workforce and higher operating expenses. Then next one is seventh one, profit margin. Companies with low profit margin often require more capital because they need to sell higher volumes of goods to generate the same amount of cash flow as business with higher margins. Then next, eighth one is cash flow management. Cash flow management. Eighth one is cash flow management. Effective cash flow management can reduce the working capital requirements. A company that maintains tight control over cash inflows and outflows can reduce the need for the external funding or excessive working capital. The next one is economic conditions. Next one is economy. The broader economic environment, including inflation, interest rates, and economic growth, can influence working capital needs. In times of economic uncertainty, business may require more working capital as they prepare for the slower sales or higher cost. Then next one is supply terms and credit availability. So the ability of the business to access credit lines or loan can impact how much working capital it needs to maintain. It a company has good access to financing, it may be able to operate with lower level of working capital. Operating efficiency. So next 11th one is operating efficiency. Business that are more efficient in their operations, such as managing inventory well, streamlining production and optimizing accounts receivable, typically require less working capital. Then 12th one is supplier terms. Favorable payment terms. So favorable terms with the suppliers, such as longer credit periods, can help reduce working capital. A company that pays suppliers later can hold into cash to the others. It is called supplier terms. Then 13th, taxation. So taxation means tax policies include sales tax, VAT or other business taxes may also impact the working capitals. Delay in tax refund or changes in the tax laws can affect in the cash flows. So next 14th one, liquidity of assets. The ace with which a company can convert asset into cash. Impact of working capital. Businesses with more liquid assets such as bills receivable, bills payable, cash in hand, cash at bank, marketable securities, etc. may need as less working capital. Then last one is management policies. Management policies also influence the working capital. So the policies and strategies implemented by the management, such as inventory management, credit collections and payment strategies, can significantly affect the working capital needs. So these are always called as factors influencing working capital. Thank you.